Let me ask you something. If the greatest investor in the world, a man worth over $130 billion, literally gave you one simple rule to follow, would you actually follow it? Because Warren Buffett has. And honestly, it's not complex. It's not sexy. It doesn't involve crypto, flipping houses, or buying gold bars on TikTok. It's just 3 words: never lose money. Simple, right? But here's the catch. Most people hear that and think it means don't make dumb mistakes. Not quite. Buffett isn't just saying don't mess up. He's saying build your life in a way where losing money becomes nearly impossible. And that's where the real secret to wealth begins. Today, I'm going to break down exactly what Buffett actually meant and the 7 wealth-building principles he follows that quietly made him one of the richest humans to ever live. Grab a notepad, because you're about to learn how to build Buffett-style money without ever losing your financial sanity. Let's dive in. Principle 1, capital protection over capital gains. First off, let's get one thing out of the way right now. Warren Buffett isn't obsessed with making money, he's obsessed with keeping it. While most investors are chasing high returns like they're at a Vegas blackjack table, Buffett plays defense. He treats every dollar like a soldier. His job isn't to send them out to die, it's to send them out and make sure they come back with friends. That's why he focuses on investments that are predictable, profitable, and proven. He doesn't bet on hype. He bets on businesses with wide moats, companies that can't easily be disrupted, duplicated, or destroyed. Think Coca-Cola, Apple, American Express. Why? Because the surest way to build wealth is to avoid financial landmines, not to leap into every hot new trend hoping to strike gold. But Buffett doesn't just pick safe companies. He picks them at the right price. Because wealth isn't just about what you buy, it's about what you pay. Principle 2, price matters more than popularity. Let's be real for a second. Most people buy stocks the same way they buy shoes, because everyone else is wearing them. It's trendy, it's loud, it feels good, until it doesn't. Warren Buffett? He's not following hype, he's following value. And here's what he always says: price is what you pay, value is what you get. Simple? Yes, but wildly misunderstood. Let's put it this way. Imagine you're at a store. There's a designer jacket selling for $400. Then you check the clearance rack and see the exact same jacket for $150. Same product, same quality, different price. Which one are you buying? If you're smart, the one that gives you more value for your dollar. That's how Buffett approaches stocks. Buffett's buying philosophy in a nutshell. He doesn't care if everyone is hyped up about a company. He's not chasing green candles or to the moon memes. He's asking, is this company actually worth what the market is charging? Does the price reflect less than what it's really capable of producing? Am I buying this stock on sale, or am I paying a hype tax? Because here's the uncomfortable truth. Most people lose money not because the investment is bad, but because they bought it at a stupid price, avoiding the greater fool trap. You know what the average investor says? Sure, this stock is overpriced, but I'll just sell it to someone else for more. That's called the greater fool theory. It works until you become the fool. Buffett doesn't play that game. He waits and waits and waits until the price drops below what the company is really worth. And then he pounces. Here's a quick story. Buffett versus the tech bubble. Back in the early 2000s, while everyone was throwing cash at dot-com stocks, Buffett sat back and watched. People called him old, washed up, out of touch. But then the bubble burst. And guess who didn't lose money? Buffett didn't avoid tech because he hated it. He avoided it because it was wildly overpriced. He didn't understand how to value it, so he didn't buy it. Meanwhile, average investors were losing fortunes chasing companies with no revenue and vaporware dreams. The Buffett mindset. Buffett isn't looking for what's hot. He's looking for what's undervalued. He wants companies with real earnings, real cash flow, real durability, being sold at a discount because the market is distracted. He's not trying to look smart in the short term. He's trying to be right in the long run. Investing versus shopping. Here's the crazy irony. People will spend hours comparing prices on a $40 air fryer, but won't blink twice before dumping $4,000 into a hot stock they saw on Reddit. Buffett flips that logic upside down. He treats every investment like he's buying the entire business. He wants a deal, a discount, a margin of safety, because that's how you follow rule number 1, never lose money. And while you're trying to time the market, Buffett's already mastering the one strategy that beats everyone: time in the market. Before we continue, when you finish watching this video, go back and watch our Financial Freedom series to fully understand the secret to building wealth. We've created step-by-step playlists and videos. Just make sure to subscribe and join the channel to stay updated. Principle 3. Compounding is the real flex. You want to know Warren Buffett's real secret? It's not insider info. It's not some billionaire boys club. It's not even his legendary stock picking ability. Nope. It's time. And more specifically, time plus compounding interest. That's it. Buffett didn't get rich because he made one great decision. He got rich because he made 1,000 good ones and gave them decades to work. Think about this. Warren Buffett started investing at age 11. Now, let me guess. At age 11, you were eating Lunchables, playing Game Boy, and trying to beat that one level in Super Mario that made you want to flip a table. Meanwhile, Buffett was buying his first stock. Why? Because he understood this cold, hard fact. Money grows slowly, and then all at once. The snowball effect. Buffett famously described building wealth like rolling a snowball. You start small, you keep pushing, and eventually it becomes unstoppable. Here's what most people get wrong. They want to throw their snowball off a cliff and hope it turns into an avalanche overnight. But Buffett, he kept rolling it. Slow, steady, relentless. And the longer it rolled, the bigger it got. That's why over 99% of Buffett's net worth came after he turned 50, and over 95% came after he turned 60. Wrap your head around that. A guy who started investing young still had to wait decades before compounding turned his millions into billions. The power of don't touch it. Imagine this. You invest $10,000 at a 10% annual return. After 1 year, you have $11,000. After 5 years, $16,100. After 10 years, $25,937. After 20 years, $67,275. After 40 years, $452,592. Same money, same return, different time horizon. Buffett knows the real flex isn't how fast you make money. It's how long you let money make itself. The problem with most people is they think like the average investor. Here's what average investors do. They panic sell at the first sign of a dip. They jump from investment to investment. They try it out for 6 months, then quit. They cash out early to buy liabilities. They interrupt the compounding. It's like planting a tree and yanking it out every 3 months to see if it's growing. Buffett, he plants it, waters it, and waits, because he knows the most powerful financial force in the world doesn't need force. It needs patience. Buffett's compounding mindset. Our favorite holding period is forever. Warren Buffett, he doesn't chase highs. He doesn't panic during lows. He stays the course and lets math do the magic. Quick Buffett stat for impact. If Buffett had stopped investing at age 60, his net worth would have peaked at a few $100 million. Still rich? Sure, but nowhere near the $130+ billion he has today. That massive difference, all compounding. That's why Buffett is the GOAT. He didn't outperform everyone else every year. He just stayed in the game longer than anyone else without screwing it up. I've said this more times than I can count, but I'll say it again. Start early. Stay invested. Let the magic work, because once compounding takes over, it becomes mathematically harder not to get rich. But don't get it twisted. Compounding only works if you survive long enough to let it, which is why Buffett's next secret is all about risk management. Principle 4. Avoid the big mistake. Let me say something that'll upset your favorite finance YouTuber. You don't have to be a genius to build wealth. You just have to avoid doing something stupid. Seriously, Warren Buffett's not rich because he took wild risks. He's rich because he mastered the art of not blowing it. That's what never lose money really means. It's not just about avoiding small losses. It's about avoiding the one decision that sets you back 5, 10, or even 20 years. So what's the big mistake? It's panic selling during a crash, putting 80% of your net worth in a hot stock you saw on Reddit, starting a business you don't understand, and funding it with debt, chasing get rich quick and ending up stay broke forever. Buffett's #1 job isn't just to grow capital, it's to protect it. Because once you lose 50% of your portfolio, you don't need a 50% gain to get it back. You need a 100% gain. That's the cruel math most people forget. Buffett's mental model, the baseball analogy, Buffett once compared investing to baseball, but with a twist. In baseball, you have to swing or you strike out. But in investing, you can stand there all day, no strikes called, and wait for the perfect pitch. Buffett watches pitch after pitch go by. Hype stocks? Let them go. Speculative crypto? Pass. Flashy startups with no revenue? Nope. He doesn't swing until he sees his pitch. And when he does, he smashes it. Real-world example, the dot-com bubble. Again, in the late 90s, people were throwing cash at anything with a .com in the name. Buffett didn't touch it. Why? Because he didn't understand the valuations, the business models, or the hype. People mocked him, called him old school, out of touch. And then, boom, the bubble burst. Hundreds of companies wiped out. Millions of investors took losses they never recovered from. Buffett, he kept building wealth while sipping cherry Coke because he avoided the big mistake. Here's what Buffett doesn't do. He doesn't try to time the market. He doesn't invest emotionally. He doesn't bet the farm on one hot trend. He doesn't let FOMO run his strategy. His investing style is boring. Beautifully boring. But boring is how you survive long enough to win. The average investor's trap. Most people want to 10x their money overnight. So they chase hype, follow influencers, ignore fundamentals, risk everything to look smart. Until, boom, a correction hits and they lose half their wealth in a week. One big mistake can undo years of progress. Buffett knows this, and that's why he stays patient, focused, and ridiculously cautious. So, what's the key takeaway? Success in investing isn't about what you do, it's about what you don't do. Buffett's strategy: stay in the game, avoid catastrophic losses, let compounding do its thing. Because when you protect the downside, the upside eventually takes care of itself. Now, avoiding disaster is one thing, but when Buffett finally finds a winner, he doesn't tiptoe in, he leans in hard. Let's talk about one of Buffett's most surprising philosophies, why he believes concentrated bets beat diversification. Principle 5, concentrated bets, not diversified guessing. Keep in mind what I'm about to tell you. Contrary to what your financial advisor says, Warren Buffett does not believe in extreme diversification. He once said, diversification is protection against ignorance. If you know what you're doing, it's not necessary. Translation: if you've done your homework and found something great, why water it down with 37 meh investments? Buffett takes concentrated positions in businesses he believes in. He loads up on winners instead of trying to hedge his way to mediocrity. He doesn't invest in everything. He invests deeply in a few things, the things he knows will last. But how does he know something will last? Because he has one filter most people never even think to use. Principle 6, invest in what you understand. Buffett has one rule before buying anything. If you can't explain it to a fifth grader, don't invest in it. He doesn't touch Bitcoin, not because it's bad, but because it doesn't pass his circle of competence test. He sticks to industries and companies he actually understands. Insurance, consumer goods, banking, tech he uses, like Apple. He doesn't pretend to be a genius in 100 areas. He's a master of a few, and because of that, he avoids the one thing that destroys most investors: confusion. And while most people are bouncing from one shiny object to the next, Buffett's doing something most investors never do. He's staying ridiculously boring, and that's the whole point. Principle 7, boring greater than flashy. Let's be honest, in today's world, boring is basically an insult. We're addicted to hype. Crypto coins with dog logos, AI startups launched by 19-year-olds in hoodies, Instagram gurus promising you'll make $10,000 a month from your phone on a beach in Tulum. Meanwhile, Warren Buffett is quietly getting richer off insurance companies and soda. You heard that right. The guy who's worth over $130 billion isn't riding trends. He's riding cash flow, and he's been doing it the same way for decades because Buffett knows the truth. Most people ignore boring businesses often make the most money and the least noise. Let's take Coca-Cola, for example. It's a soda. It's been around since your grandparents were teenagers. There's nothing new, edgy, or revolutionary about it. And yet, Buffett has owned shares in Coke since 1988. Why? Because people drink it every day. It has global brand loyalty. It prints consistent profits, and it's practically recession-proof. Flashy? No. Predictable? Yes. And that's exactly the point. Buffett's portfolio isn't sexy. It's solid. Want to know what else he's invested in? Apple. Not because it's trendy, but because it's a cash cow with an ecosystem of loyal customers. American Express, because people love points, perks, and plastic. Bank of America, because banking isn't going away anytime soon. Geico, because people need car insurance more than they need NFT art. These aren't stocks that make headlines. They're stocks that make dividends. Why boring wins. Buffett doesn't care if it's exciting. He cares if it's durable, profitable, easy to understand, built to last 20+ years, because flash fades. But boring is reliable. The average investor's mistake. Most people treat investing like a video game. New levels every week, new characters to chase, constant stimulation. But guess what? That's why they lose. They're not building wealth. They're chasing dopamine. Buffett wins because he trades excitement for execution. He doesn't care if it's boring. He cares if it works. Buffett's favorite holding period? Forever. That's how he thinks. Not, how can I double this money in 6 months? But, how can I own a piece of a great business for 30 years? Because when you pick the right horse, you don't need to keep switching tracks. Bottom line, Buffett doesn't need fireworks. He needs fundamentals. So while everyone's out here trying to go viral with their portfolio, Buffett is quietly collecting checks from companies that have been winning since before the internet existed. Buffett's secret isn't hidden. It's just not sexy enough for most people to follow. Because he knows the real truth. Wealth doesn't come from gambling, it comes from not screwing up and letting time work its magic. So if you're serious about building real wealth, not just flexing on Instagram, then take a page out of Buffett's book. Ask yourself, are you investing in what you understand? Are you protecting your money like your life depends on it? Are you playing the long game or chasing short-term hype? Because if there's one rule that stood the test of time, it's this. Rule number 1, never lose money. Rule number 2, never forget rule number 1. If this video gave you clarity, hit that like button. In fact, there's actually a specific set of advice you need to understand if you truly want financial freedom. Just click the video on the screen now to get the full scoop. We'll see you in the next one.